The Nebraska Unicameral is considering legislation this session to address property tax relief for ag land. On average, Nebraska producers pay more real estate and personal property taxes than any of the other states measured by the U.S. Department of Agriculture. In 2015, that amount was nearly $25,000 per farm, nearly $11,000 more than the next closest state, California, and much higher than the $9,500 per farm in neighboring Iowa. Taxes as a share of production expenditures in Nebraska at 5.3% was also the highest in the nation. The Nebraska legislature did act last year, adding $20 million per year to the state's property tax credit program for ag land, but supporters of reform are hoping for more. On Wednesday, we talked with Nebraska Extension Policy Specialist Brad Lubben about the effort this session.
Well, clearly we have a big discussion on property taxes, and from the agricultural community's perspective, certainly a focus on the amount of and the increased burden that the ag sector has paid in terms of property taxes across the state. One of the fundamental discussions right now in the legislature is about changing the assessment formula or the assessment method for farmland from the current market-based approach, consistent with other classes of property, to an income-based approach that might provide a little more predictability, maybe more stability, and a little bit of more relief in terms of ag's share of the property tax burden.
Go further on how legislation would address that issue.
Yeah. Well, fundamentally, let's remember, if we move to an income-based approach, we fundamentally have some income value, revenues minus costs, either calculated for the crop production, livestock production system directly, or calculated as some sort of landlord's share of those, divided by some capitalization rate, interest rate, mortgage interest rate, gives you market value, or at least calculated market value from this income approach. There are a couple bills in the legislature right now proposed. Both would use some sort of long-run average to calculate revenues and costs to calculate a net return to land. In one bill, the capitalization rate would be set at 6%, which might be consistent, or at least in the neighborhood of where mortgage interest rates currently are at for farmland, but where that moves over time might be a question. The other bill, however, actually says let's use effectively a market-determined capitalization rate. If we have an estimate of net income to the land and we have an estimate of market value, then the capitalization rate effectively is what the market seems to be willing to pay for land that has this earning capacity. However, if you use that market-determined capitalization rate, then fundamentally we're not really changing to an income approach. We're changing to maybe a more stable estimate of what the market really must be willing to pay.
When you say stable, that brings to mind some of the issues that agricultural producers have had when it comes to income versus the property taxes that they're paying. Now these, or at least some of this, would be addressed in these legislative bills.
We would expect under this income-based approach, I think, with both bills proposing some longer run average, that you won't have as many swings like we see with farm income. Rapid rally, sharp decline. You won't have the land value itself sort of smooths that out a bit, but this longer run average calculation would certainly smooth out that a bit. You wouldn't see quite the peaks and valleys that we could see today based on a wildly moving market.
In the rural areas of the state, there's obviously a discussion that will need to be had if there is reform in this area, right, about how tax funding is right, set in future years.
Well, yeah, fundamentally, let's remember, even if the income approach provides relief to producers, and it certainly might provide more stability or predictability and uniformity across classes of land, but even if it provides that, it doesn't guarantee substantial property tax relief, particularly in a very rural district where farmland is the core of the assessed value. Even if assessments pull down, or even if the approach pulls down assessed values, as long as tax collections are over on the other side of the equation, it just affects the levy rate more than it affects total tax bill. So there's more to this whole property tax question than just the assessment approach, but this might be an interesting and valuable discussion to start.